Which takes us to our talk of the tape. Is this market just taking a breather before launching its next leg higher, or has momentum just grinded to a halt? Let's ask Adam Parker. He is Trivariate's founder and CEO and a CNBC contributor. Welcome back.
Thanks for having me.
You make the argument that dips should be bought. Why?
Well, I think most institutional investors think we're going to get some kind of growth scare, maybe a stagflation scare here August through October.
Is that what this is now, you think?
I don't know, not yet, but I think people want to buy high-quality stocks if they go down 10-15%, 10-15%. So it makes me think we're not going to get a very big sell-off. I don't know. When I looked at the earnings season, the trajectory of earnings, they're higher. I don't feel more negative today about 26 and 27 earnings than I did a month ago. So, obviously markets don't go up every day, but I don't think the valuation's a problem, kind of looking at the way you set up the segment. I mean, there might be individual names where I find it challenging, but at the market level, I'm comfortable with it because I think that margins are probably going up for the average company, and I still have this pretty solid dream that I'll get productivity for a lot of companies in the next 18 months.
You talk about a dream. The reality, according to Brian Moynihan, who was just obviously on exclusively on this network, sounds pretty darn good. Consumer hanging in there. Don't pay attention to what they say. Pay attention to what they do and their spending. No rate cuts coming this year. He alludes to the fact that maybe you don't need them because his people say no recession. And he's as close to the front line of the consumer as you can get in a job like he has. Right. He sees everything. On tariffs, you're starting to see the goalposts, so things are more clear. That's a plus. IPO and M&A, the pipelines are full, he said. You want to sell stocks listening to that?
I don't know if he's repeating back what I said to you last week during our segment. It sounds like it.
It's hard to be negative listening to Brian Moynihan.
I mean,
don't you think?
The bank earnings were really good across the board. Visa, they provisioned less for consumer losses than we thought. So I think the aggregate consumer is in pretty good shape. Maybe eroding from highs, but still in good shape. And I don't even think that's listed off as one of the bear cases in my meetings now. I think it's more, ASML told us there's tariff problems. Market probably can't rip if semis don't work well. So maybe I got to focus on semis a little bit. Maybe the bank earnings were good and the stocks didn't go up very much. Maybe that's a little bit of a tactical concern. For some reason, everyone thinks that September is, on average, a bad month.
Well, I mean, historically, it's
you need
great.
1,000 years for that to be statistically significant. I think we just had, randomly some stuff in September. So, I don't know if people want to say that's when we get a sell-off, but I think that was born out of something that's unlikely to happen this time. I think in the past, you got negative revisions in September. People come to New York, they go to big tech conference in September after Labor Day, and the numbers get cut. I don't think so. The numbers are coming up right now for both 25 and 26 based on what we just heard in July. So I think the risk score is skewed to the positive for year end, and any kind of material weakness I think is going to get bought for the dream that earnings are going to be good next year.
Well, I feel like the point that Moynihan makes too is that we've got the best companies, right? And we got the best CEOs.
Right.
And they know what the heck they're doing when they actually can see in front of them. His point was now things are more clear, so we collectively as the CEO cohort can better operate our businesses and we'll figure it out. Do margins maybe take a little bit of a hit here and there? Maybe.
Maybe not. Yeah, maybe.
But maybe not.
I agree with that. Look, I got asked that in a client Zoom earlier this morning in front of a big group about non-U.S. versus U.S. equities, and I just go back to the themes that I think are going to grow above global GDP. The U.S. companies are overexposed to them. So, maybe in some short-term window here, you think the dollar weakens, you think we're on a different policy path, but in the end, the companies we have, tech, comm services, our financials here, are 58% of the S&P, and I think they're generally pretty well positioned for earnings growth for the next 2 years. So, yeah, I like the U.S. equity market.
But, I mean, if we're going to have a growth scare, as you suggest, is possible, whether this is the early stages of it following the jobs revisions,
right?
That makes it harder then to go outside and far away from big tech and AI, doesn't it? I mean, I'm not going to buy small caps, am I, if I'm worried about a growth scare? I'm not going to go down the cap space much at all if I'm worried about the economy slowing down more dramatically, am I?
No, I agree with that completely. And I think the biggest issue for a lot of long-only investors trying to beat the S&P in the last 3-4 months is low-quality stocks have outperformed, and it's hard to kind of go down and buy some higher beta and buy some lower quality to keep up. So
if people are doing that.
Right, and they are, and they've been forced to. The retail investor doesn't care. But I think the institutional guy, it's harder, especially if they have lower turnover. So I think maybe if we get a little bit of what we call a deposit, maybe we're just getting a little rotation out of some of the high flyers into some, kind of higher quality names. That could actually help the market, go up higher later in the year.
What if Moynihan's right and the Fed doesn't do anything for 25? Is that a market problem or no?
No, I actually agree with that part in particular of what he said. I don't think it's good if they cut. We talked about it before where I just think they're only going to cut if they see data that really deteriorated. They lag. The Fed lags. I mean, we know what the prices move first. Generally, the price action the last 3 months has told you their earnings are going to be better next year than you thought. Economy's going to be better. Then the next thing we all gathered real-time data. We're going to LinkedIn for jobs data, not for the BLS or whatever. Then what? You get the corporate earnings results. We sweep all the transcripts. We look for every phrase we can. We mine it all. That's what everyone does, right? Then what? We get economists giving us we get the data. And then lastly, the Fed reacts to all that. So we know it's super lagged. So I don't think the Fed's going to act unless things really deteriorate. And I think the market will be down a lot before they do.
Well, I mean, it remains a critical question.
Yeah.
Hang with me for a second.